Picture two guys, same age, same income, same city, same $50,000 sitting in their bank accounts. One of them buys a rental property. He's got keys, a tenant, a mortgage, and a story people actually listen to at dinner. The other one opens a brokerage account, clicks a few buttons, and never thinks about it again. His coworkers nod politely when he mentions it and immediately change the subject. 20 years later, one of them is significantly wealthier than the other. But it's not the one you think, and even that's not the full story. Because when you actually run all the numbers, the ones nobody puts in the YouTube thumbnail, the answer gets uncomfortable. If you've ever thought seriously about buying a rental property, or wondered whether the stock market is just a quieter path to the same place, this one's for you. Hit subscribe and stay with me, because the math we're about to walk through changes most people's assumptions completely. Let's make this clean. Jake and Marcus, both 30 years old, both earning $55,000 a year, both sitting on $50,000 in savings. The only variable is what they do with that money. Jake puts his $50,000 as a 20% deposit on a $250,000 rental property, a solid 3-bedroom in a decent neighborhood. He takes out a 30-year mortgage at 7%, monthly payment around $1,330. He finds a tenant willing to pay $1,800 a month. That's $470 in profit before anything goes wrong. Jake feels like a genius. Marcus takes the same $50,000 and drops it into a total market index fund. He sets up a $300 monthly automatic contribution and doesn't look at it for 3 months. His friends ask him what he's investing in. He says index funds. They nod. They move on. Nobody's impressed. Day 1, Jake has a house, a tenant, and a narrative. Marcus has a confirmation email. It's not even close in terms of how it feels, but feelings and math, completely different things. For the first couple of years, Jake is living the version of landlord life that gets posted online. Rent hits his account on the first of every month. He drives past the house on his way to work. He thinks, I own that. He's writing off mortgage interest on his taxes. He's watching comparable homes tick up in value. Every part of this feels real, tangible, and smart. Marcus logs into his account once a quarter. The number goes up a little, down a little, up a little more. Year 1, his $50,000 becomes roughly $55,000. Year 2, maybe $61,000. Nothing about it feels like anything. There's no key in his pocket, no tenant, no asset he can point to from a car window. Just a number on a screen, quietly doing something most people can't feel until it's already enormous. Jake is winning the conversation. Marcus isn't even in it. But by year 3, something starts to shift. Over 3 years, Jake has collected roughly $64,800 in rent. His total mortgage payments come to about $47,880. On paper, that's $16,920 in cash flow. A solid number, the kind of number people quote at barbecues. Then reality sends an invoice. Property taxes, around $3,000 a year. Insurance, $1,500 a year. One water heater replacement, $1,200. A leaking roof that couldn't wait, $2,800. 1 month of vacancy between tenants, which means no income but a full mortgage payment plus $600 to clean, relist, and show the property. And Jake is managing it all himself to save money, which means 10 p.m. phone calls, weekend viewings, and coordinating a plumber from his lunch break. After real costs, his actual net cash flow over 3 years is somewhere between $2,000 and $4,000, not $16,920. Not even close. Marcus, meanwhile, has contributed $50,000 up front, plus $10,800 in monthly additions. At roughly 10% average annual return, his portfolio is sitting around $76,000. He put in $86,000 total. The other $118,000 or more is pure compounding. No debt, no tenants, no 2 a.m. calls about a burst pipe. Same ballpark, completely different experience getting there. Now look, if I only showed you the downside of real estate, I'd be doing what every stock market influencer does. Because index funds have their own brutal reality. In 2008, the market dropped 37%. In March 2020, it fell 34% in a single month. If Marcus had $150,000 in his portfolio and watched it become $95,000 in a matter of weeks, that's not a number on a screen, that's visceral. And the data is clear. Most retail investors panic sell during crashes and buy back in after the recovery. They lock in the loss at exactly the wrong moment. Index funds also don't send you a monthly check. Dividends on a total market fund run maybe 1.5% to 2% annually. On $150,000, that's around $200 a month. That doesn't replace an income. And there's no leverage. Marcus used $50,000 to control $50,000 in assets. Jake used $50,000 to control $250,000. That 5-to-1 ratio is the single most powerful thing real estate has that stocks simply don't. Real estate also has depreciation, a legal tax shelter that lets you deduct the theoretical decline in your building's value even while the property is actually appreciating. Stocks have no equivalent outside of retirement accounts. Real estate wins, clearly and decisively, when the rent-to-price ratio is strong, when the investor treats it as a business rather than a side project, when they screen tenants carefully, build systems, and plan for capital expenditures before the invoice arrives. Strategies like house hacking, where you live in one unit and rent the others, can reduce your own housing costs to near zero while building equity. That's something the stock market fundamentally cannot do. Jake and Marcus both walked away from their decision convinced they'd made the smart call. Neither of them actually sat down and mapped out what it would cost, in dollars, in time, in stress, and in risk before they committed. The real trap isn't real estate. It's not the stock market either. The real trap is making a 20-year financial decision based on a podcast clip, a YouTube headline, or something your uncle said at Thanksgiving, without ever running the full numbers for your own situation. And if you're wondering what happens when you do both, when you own property and invest in the market simultaneously, the math shifts again in ways that might change everything you think you know about building wealth. But the next time someone tells you real estate always wins or the stock market always wins, just ask them one question. Did you include everything? Because the answer that includes everything is the only answer that matters.